Welcome to your favorite channel for learning everything you need for financial success. Let's get started.
All right, let's talk about something we've all experienced. You get a job, you're excited about the salary, and then your first paycheck hits your bank account and you think, wait, where did the rest of it go? Well, today we're going to solve that mystery. We are going to break down the US paycheck step by step so you know exactly how to calculate your real take-home pay. Here's our game plan. First, we'll lay out the puzzle itself. Then we'll find our starting number. That's your gross pay. After that, we dive into the big one, taxes. Then we'll look at the deductions you can control. And finally, we'll put it all together to find that magic number, your net pay. So let's frame this up. The whole thing really is a puzzle. It's about figuring out the journey your money takes from that big salary number you were promised to the smaller number that you can actually spend. And by the end of this, you'll know how to solve it. I mean, it's a universal feeling, right? You see that headline salary, but what ends up in your account feels, well, a lot later. That gap is exactly what we're going to tear down today, so you can see where every single dollar is going before it ever gets to you. To even start this, we need to get two key terms straight. First, you have your gross pay. Think of that as your starting line, the total untouched amount you earned. And then you have your net pay. That's the finish line, the money that's actually yours. Our whole mission here is to map out the road between the two. Okay, so let's find our starting number, gross pay. Everything, and I mean everything, starts from here. Before we subtract a single penny, we have to know the total amount you earned for a given pay period. So, how do you find this? Well, if you're on a salary, it's pretty simple. Just take your annual salary and divide it by how many paychecks you get in a year. If you're an hourly worker, just multiply your hourly rate by the number of hours you worked. And hey, don't forget to add in any extras like bonuses or commissions. That's all part of your gross pay. Now, to make this really stick, we're not just going to talk in theory. We're going to follow a single example from start to finish. Let's imagine we have an employee who makes an annual salary of $55,000. We're going to track this exact salary through the whole process. And here's where a key detail comes in: how often you get paid. Let's say our employee gets paid semi-monthly, which means they get 24 paychecks a year. So we take that $55,000 salary, divide it by 24, and voila. We get a gross pay of $2,291.66 per paycheck. This is our starting number. Okay, take a deep breath. Now we're getting into the biggest and honestly the most confusing part of the puzzle, your taxes. This is where the largest chunks of money are taken out, so let's walk through it nice and slow. If you think of your withholdings like a pie, there are a few main slices. First, you have FICA taxes. That's for Social Security and Medicare. Then there's the big one, federal income tax. You'll probably have state and maybe even local taxes too. And finally, there's a slice for all the other deductions. We're gonna look at each one. Let's start with FICA taxes. This is a flat tax, which means the rate is the same for everyone. It's made of two parts. 6.2% goes to Social Security, but only up to a certain income level each year. The other 1.45% goes to Medicare, and that applies to every single dollar you earn. So that's 7.65% total coming out of your check. And what's really important is that your employer pays the exact same amount on your behalf. All right, next up is the federal income tax, or FIT. Now, unlike FICA's flat rate, this one is a progressive tax. All that means is that the more money you make, the higher the tax rate you pay on some of that money. It's done through a system of tax brackets. Now, pay close attention, because this is where a huge misconception lives. People look at this chart and think, oh, I make $55,000, so I'm in the 22% bracket. All my money is taxed at 22%. No, that is not how it works. You only pay that rate on the money that falls inside that bracket. So for a $55,000 earner, their first 12 grand or so is taxed at 10%. The next chunk, up to about $48,000, is taxed at 12%. And only the little bit of money above that is taxed at 22%. It's a ladder system. So you're probably thinking, how on earth does my employer figure this all out? Well, it all comes down to that W-4 form you filled out on your first day of work. You tell them your filing status, about your dependents, and any other adjustments. They take that info, figure out your taxable income, and then use the official IRS tables to see exactly how much tax to withhold. Okay, we've made it through the mandatory taxes. Phew. Now we get to the part where you actually have some control. Deductions. These are the choices you make about things like retirement and health insurance. And listen up, because this is probably the most important money-saving tip in this whole thing. Deductions come in two flavors, pre-tax and post-tax. Pre-tax deductions are amazing. They're taken out of your gross pay before your income tax is even calculated. That means they lower your taxable income, which saves you money. Post-tax deductions come out after all the taxes have been figured out. So knowing the difference is key. The most common pre-tax deductions, the ones that lower your tax bill, are things like your health insurance premiums, contributions to a traditional 401k, or an HSA. Now, on the flip side, a Roth 401k contribution is post-tax. And then, of course, some deductions aren't voluntary at all, like wage garnishments. Okay, we have all the pieces of our puzzle laid out on the table. It's finally time to put them all together and calculate our net pay. The entire journey, from that big salary number to what you actually get, boils down to this one simple formula. You take your gross pay, you subtract your taxes, you subtract your deductions, and what's left over is your net pay, your take-home pay. Let's go back to our employee making $55,000 a year. We established their starting point. Their gross pay per paycheck is $2,291.66. First thing we do is subtract the FICA taxes. That combined 7.65% rate comes out to a deduction of $175.31. So we take that out. Next, we subtract the federal income tax. Now, this number is going to be unique for everyone. It totally depends on their W-4. For our example, we'll say that after accounting for some pre-tax deductions, the amount to withhold is $23.39. Your number will almost certainly be different. So after subtracting just those two main taxes in our very simplified example, we arrive at a net pay of $2,092.96. Now, keep in mind, to get your actual net pay, you'd also subtract state and local taxes and your deductions for things like your 401k and health insurance. But this shows you the core of how it's done. And there you have it, the paycheck puzzle solved. The formula is the same for everyone, but the numbers, your income, your taxes, your deductions, that story is uniquely yours. So the real question now is, what story does your paycheck tell? Go ahead, take a look. Now you know exactly what you're looking for.
Before we finish, let me give you a few tips. And remember that we upload videos every day.
All right, let's talk about building healthy finances and a real savings fund right here in the US. Let's be real. If you feel like the financial deck's stacked against you, you're not wrong. It's a fact. For the first time ever, 30-year-olds are often earning less than their parents did. A lot of this is policy. It's made things like housing and education just explode in cost. But here's the thing, you still have power, and it all starts with your mindset. Forget being rich, that's just stuff you see. The real goal? To be wealthy. So what's wealthy? It's when your money makes enough money to cover your expenses. That's freedom. This is your why. It's about funding a meaningful life, not just collecting more stuff. Okay, so how do we start? Let's build momentum with some quick wins for your savings. First up, try a no-spend challenge. It's a total reset for your spending habits. Next, the $1 rule. This little trick makes you think about the real value of your purchases. It's simple math. You end up buying quality things you'll actually use for years. Then there's the $20 rule. This builds your saving muscle, making it totally automatic. And here's the cool part. Combine these small hacks and you can save some serious cash. Saving is just step one. Next, we turn those savings into a real wealth-building engine. This number, it's the biggest reason to start investing as early as you possibly can. Check this out. Every dollar a 20-year-old invests could become $88. That power drops off fast. So, how do you do it? Well, you don't need to be some kind of expert. The key is to automate it. This is like a forced savings plan that just works. The big goal? Aim to save and invest 20 to 25% of your income. It's a game changer. So why do all this? The payoff isn't just money. It's a whole new way of life. You go from a life run by financial stress to one where you call the shots. And really, this says it all. Your money just becomes a tool for the life you want. You're building the resources to truly live, not just retire someday, but live now. So you have two lives. When does your second one begin? The choice is yours.
We upload videos every day. Subscribe and become part of the family. See you tomorrow.